to your accountant and say, hey, most people will send it and I don't do much of it. And then they will also add the avoided check. What does it mean? It as if it's automatic that when you get W-2, you must have a refund. That is the way that's the whole misconception about it. And in fact, filing your taxes does not mean that you are going to get a refund back. You are only paying your fair share of the tax. And if there's anything left for you, you get the refund. So refunds are not automatic. And that's where the missing link is. And so in most cases, if I'm allowed to share my screen, I'll share some few things for you. The most important part of what Mr. Mintah has just said is how we plan. See, tax planning is not all about getting refund. It goes way beyond that, right? It goes, retirement, your estate, whatever you do, tax planning is not only for a tax refund. We are only interested in that because that is what gives us money back as a refund. And so if that is what it is, then we must be very careful the way we handle our tax withholding certificate, which is the form W-4. I'm sure most of you here know the form W-4. W-4s is what you tell your employer. But if you can make me a host, a co-host, I can share my screen. W-4s these are the forms. One of the forms has been changed since 2020 after TCJ Trump tax reform. W-4s are actually meant. Yeah, I will share my screen. They're actually meant to calculate basically your marginal tax bracket. And then Mr. Mintah has already told us the bracket from 10% all the way to 37%. These are all marginal tax brackets. And I'm glad to share my screen so that you cannot share your screen. Papa, yeah. Okay. And so, again, the W-4s are very important. So when you go to your payroll manager, your payroll director and said, hey, I want to complete a W-4, then the system determines your tax bracket, which is basically your marginal tax bracket. And when you file your taxes, if you go to Mr. Mintah or anybody else, your accountant, and file your taxes, you are actually getting to know your effective tax bracket, right? So when your marginal tax bracket is bigger than your effective tax bracket, obviously you get a refund back. But when your effective tax bracket is lesser than your marginal tax bracket, you have a balanced deal. That is why it's important that we understand how W-4s are completed at work. And I'm sharing my screen so you can see the form I'm talking about. I'm sure some of you have already seen, for most of them here. Okay, this is
the screen.
Yeah, can you please see my screen? Yes. Okay. So this is the form I'm talking about. This form has changed since 2020. So if you haven't completed a new W-4 since 2020, you need to go back to your payroll director or manager to look at it. Otherwise, you are being taxed under the old tax bracket that we had before Trump, when the TCJA was actually part Tax Cut and Job Act of 1918 was passed. This is the form that determines. It has 5 steps. Whether you are single, married, filing separately, or head of household or jointly. Years ago, before 2020, you could say, I have 2 kids, I have 2 dependents, no more. Okay? You can't claim any more dependents on, I have 2, or I'm claiming 5, I'm claiming 2. The state, yes, but federal, no more since 2020. So what has happened? What has happened is that in most cases, people get balanced deal on their taxes because they have failed to be taxed appropriately based on their marginal tax bracket. So there are certain forms in IRS used for tax calculation that are very crucial, that every one of us must be able to understand how they operate, how to complete that form. So there are so many ways of computing your tax bracket, like Mr. Minter said, but the most common one, almost all of them depend on your W-4, which actually calculates your marginal tax bracket. I'm going to show you how the two brackets work. If since 2020, allowances can no longer be claimed. It doesn't work that way. Mr. Minter has already showed us that now, because of that, your standard deduction has been bumped up to make up for that. So you cannot claim allowances like 2Ks, 5Ks, 0, whatever it is. So W-4s are very, it's the source. Basically, it's the source that you actually have to tell your payroll person, do it this way. I am married, but I want to file single when it comes to taxes. I am married, I want to file jointly. I am the head of household. And the payroll system will calculate your taxes based on that instructions. And what is it doing? It's only calculating the bracket that you have determined, your marginal tax bracket. So eventually, what happens is this: the 5 steps must be followed. The most important part of these 5 steps is where you said I'm single, married, or head of household. And when you sign, you can leave everything as blank because that is what the system uses. So again, people will say that, you know what, I want to claim exempt. IRS doesn't force anyone. If you say you want to claim exempt, that's fine. But then at the end of the day, when you get your W-2, you realize that you have 0 taxes withheld. What it means is that more likely than not, you're going to have a tax liability. So when you realize that, hey, I don't qualify for exempt, within 10 days, you have to go back and fix it. Otherwise, when you file your taxes, you may end up blaming your tax accountant that didn't do a good job, but then you cost it because you had a lower tax, marginal tax bracket calculated as against your effective tax bracket. Now, in view of that, the accuracy of your W-4 will help you throughout the whole year to balance your tax and see how things work. In some cases, IRS may send a letter and say, listen, employer, Mama Letitia is claiming these exemptions, and so lock her in as single and 0, meaning that don't allow her to take any other allowances. So it's something called lock-in letter, where when you withhold your taxes, IRS will step in with a letter to your employer and said, this person is under withholding. Please don't allow her to do, or him or her to do this and do that. And then you can't make a change to your W-4 until that lock-in letter is released. Very important, because most people who have a liability at the end of the year is because they have failed to complete the basic form W-4, because that is what it tells your payroll person how you should be, what bracket you should be in, at least for now. And that is why the two things come in, the two brackets, the marginal tax bracket versus the effective tax bracket. Now, the bracket depends, and again, we just said it from Mr. Minter, that depends on your filing status. And so the marginal tax bracket is at your top dollar of income where it falls. Where it falls is your marginal tax bracket. So I made $10,000. Where does it fall? It falls within the range of 12%. Boom. That's where I fall. That's my marginal tax bracket. But when I file my 1040, my tax return, then my effective tax bracket is also determined. I can compare the two, and then I said I paid more taxes through my marginal and less taxes for my effective, I can get a refund back. So there's a system in place for a refund. It is not just automatic that you get a refund when you didn't pay any taxes, unless you probably have earned income credit, which Mr. Minter talked about. Now, the effective tax bracket is obviously an average rate that you pay in taxes based on your taxable income. So it is, you can calculate your effective tax bracket by dividing your taxes by your taxable income to know that what bracket you fall in. That is your effective tax bracket. That is the bracket you compare to your marginal tax bracket to find out whether or not you have a refund. So I keep on stressing that refunds are not automatic. You have to know your tax structure. You have to know your tax. You have to understand it from day one. This we are already in January. If you have to go and revisit your W4, please do so. If you haven't changed your W4 since 2020, you need to go back and look at it. Otherwise, it's more likely, maybe not, more likely you owe and pay tax liability. So, in conclusion, for these two brackets, the marginal tax bracket again corresponds to the highest bracket of where your income falls. The effective tax bracket is exactly what you pay based on your taxable income. So essentially, your refund that you get is the comparison between your marginal and your effective tax bracket. And you know, see, taxes are, it might not be the fault of your accountant. It's because you have less taxes withheld. If you don't have any credit, like we talked about a couple of minutes ago, if you don't have any deduction, enough deduction, it's more likely you're going to owe. And that is not the fault of your accountant, it's the fault because you did not review your W4, not only the federal, the state, the IT 2104 for New York State. Or if you're in any other state, you can look at your state taxes, and also those forms, you have exemptions, you have allowances. I can claim 1 or 2, that is fine, but not the federal side, right? So that is how W4s work. It's a very, very important document that we can't play with it, because it is all, that's where everything begins when it comes to tax refund and how it comes to the bracket that Mr. Minter just talked about. And let me just jump into estimated taxes. Now, when you are an employee of a company, of a corporation, your employer decides to take FICA, Federal Income Contribution Act, which is 6.2% of your taxable income and 1.45% of your taxable income, Medicare taxes and Social Security taxes. Together, you get 7.65% from your paycheck. So if you make $1,000, $76.50 will be withheld from your paycheck. Your employer is supposed to match that amount dollar for dollar and pay the same 7.65%. So together, you have 15.3% of your $1,000. That amount is sent to SSA, because Social Security Administration, so that when you retire, you can get a benefit. We'll talk about that later on in the near future, how that is computed. But when you are self-employed, you are both the employer and the employee. Nobody pays your FICA, your Social Security for you, or your Medicare taxes for you. You pay it yourself. Even though there's allowance or there's an adjustment to it, one half of it on your 1040, you pay both the employee portion and employer portion. So what has happened in most cases is that if you are self-employed, you don't pay FICA, Federal Income Contribution Act of 1986. You rather pay SICA, which is called Self-Employed Contribution Act. The same percentage, 6.2% for Social Security, 1.45% for Medicare taxes. When you are self-employed, because there's no employer withholding, you don't complete W4 when you are self-employed. If you're a daycare provider, if you are a landscape owner, if you're a photographer, and you are self-employed, you don't complete W4. W4s are only for people who are employees, and where the employer is supposed to be withholding this 6.2 and 1.45%. So when you are self-employed, you complete a form called Schedule SE, self-employment. That is the form you complete when you file your 1040. But most cases, people get liability when they file their tax because they wait to the last minute to see Schedule SE. So there's a need for you to do estimated taxes and say, you know what, I'm going to make $100,000 a year. Because of that, I want to estimate my taxes and pay some amount every quarter so that by the time I file my taxes, I don't have too much taxes to be a liability to be paid to IRS. And that is why IRS Form 1040E as an Edward, S as in Sam, ES is there. It's there so that you can compute, or your accountant can help you compute your estimated taxes and you pay it quarterly. I will show you the schedule. So if you are self-employed and you make a net earnings of $400, you need to file your taxes. At least $400, you need to file your taxes. But here is the catch. What is the catch? The catch is that when you are self-employed and you are supposed to file estimated taxes, some conditions must be met. Okay? Two conditions is that if your liability is that if you owe at least $1,000, okay, of withholding and credit, or if there's something called 90, 100, 110 rule. Now I'm going to explain that. 90% of your current taxable income or 100% of your previous tax return, and if you make more than $150,000 a year, then it's 110%. That is what you use to determine. The smallest of the three is what you use to determine your estimated taxes. Or if you are you know that you're going to owe more than $1,000 at the end of the year, you need to estimate your taxes. Estimated taxes are very complex, not complex, but it is much concern. And because we have ministers on this platform, I want to say this. When it comes to ministers have two hats. They are employees when it comes to federal income taxes, and they are self-employed when it comes to Social Security and Medicare taxes. All right. So you're going to see that on the record of IRS, most ministers have a huge tax liability because they fail to have taxes withheld. I mean, you can decide to have a W-4 completed, but when it comes to Social Security and Medicare taxes, ministers are supposed to be self-employed. That's why it's a bit complex when it comes to ministers' tax return. So if you know that you have no Social Security withheld, you have to do estimated taxes. Otherwise, when the year ends, you would definitely have a tax liability. And the schedule is this. It's a quarterly return. So between January and March, you have to pay your estimated taxes on the 15th of April, between April and May 31st, June 15th, between June 1 and August, September 15th, between September 1 to 31st. You can pay it on the 15th, or you can also file your taxes with it at the time that you are filing your 1040. So essentially, what you are saying is that when you are self-employed and there are no taxes withheld, it's very important that you consider paying estimated taxes. Since you don't pay, you don't complete W-4, there's no employer. You are yourself, you've employed yourself. So you don't complete W-4. You need to do that estimated taxes. Very, very important thing. And my experience with tax returns, I've had this happen to people, huge liability because they fail to that. Some of our sisters do a private living, private cases. They don't withhold taxes. And so when they file their taxes with the person used the income they pay you to file, you have to also report it. Because tax filing is a double entry, right? The person pays you, it's a deduction for the person, you receive it, you got to pay the taxes. Two sides washes out. So it's important that we do, if you are a taxi driver, if you are a private case employer, if you are self-employed, you got to do estimated taxes to avoid any huge tax liability when it comes to 1040. And so difference between self-employed who doesn't complete W4 and then employee who is supposed to complete W4 to calculate your marginal tax bracket, this is how you should look at it from that angle. And I'm going to just end this by looking at talking about retirement plans. And I told Mr. Minter, this is a huge topic. I'm only going to do some few highlights, and then if you have any question after that, we can talk about it. Retirement plans are there for us to put money aside so that when we can no longer work, we can receive some sort of income. That is why Social Security benefit is not a pension plan. Social Security is just a social intervention. It's not a pension plan because it doesn't fall within the code section 415 of the code of the IRS. It doesn't fall in there. But when you have 401k, 403b, 457b, IRAs, these are all retirement plans, and these are qualified retirement plans. And I can spend days to work on this, but let me just give you some few highlights. If you have a former employer and you are now moved to, let's say you work for Goldman Sachs and now working for Thomson Financial, and you had a pension plan with Goldman Sachs, you can roll over your pension plan to your new employer. You can do so without any tax. The idea of pension plan, is, like I said, is to save money for that. When the pension plan is qualified, it means that it's enjoying some tax benefit, it's tax favored. And so what happens is that you can do a pre-tax deduction from your paycheck, or you can do a post-tax deduction, which is the Roth retirement plan, 401k. Whether you do a pre-tax or a post-tax will depend on your tax planning, which your accountant will sit you down and explain to you. Because depending on your tax bracket when you retire, will influence whether you should do a pre-tax deduction today or you should do a post-tax deduction. So that's why the name Roth IRA is there, or Roth 401A or 403B and blah, blah. Again, let me state that 401A is not a pension plan. 401A is a tax code. A tax code explaining that you can find everything about this pension plan under this tax code. The actual pension plan, two major ones are defined benefit plan or defined contribution plan. Under it, we have profit sharing. We have all the kinds that we have, and it's mostly IRAs. So my point is that you can roll over your distribution to another company without paying any penalty, unless you receive the check yourself and you keep the check 60 days from the day you receive it, then it becomes a distribution. In that sense, you have to pay taxes on it. But it's a good idea to roll over your pension plan to your new employer. Let them do it themselves. Don't get a check. If you get a check, you forget 60 days distribution. You got to pay tax on it, right? In most cases, every pension plan has a plan document, which is an internal document. The plan document explains who qualifies, who doesn't qualify, what is considered an income when it comes to calculation, define contribution, what are we defining? But then when it comes to, in general, when you are at the age of 59 and a half, over that, you can start taking distribution from your pension plan, your asset, the portfolio. When you are below 59 and a half, there's 10% penalty for taking that. They call it additional tax. And so, of course, there is exception to the rule, which I'm going to talk about. But if you take your pension plan before 59 and a half, you pay a penalty, right? Now, the penalty can go up to 25%. If you put that pension plan in your portfolio and within 2 years, you take it back, then the 10% penalty becomes 25%. So withdrawals have limited restrictions and limitations. The penalty that you pay, if you say that I'm taking the pension plan to go and pay for my medical expenses, you can avoid the 10% penalty. For my tax, I owe IRS some money. I want to go and pay them. If you take the pension plan before 59 and a half, you don't pay the 10%. There are more than 15 exceptions to the rule. If you qualify for any of them, you will definitely not pay the 10%. That is why when you receive the 1099-R, it tells you the code under which you took the money. And that code determines whether the 10% should be applied or otherwise. Right? So we should be very careful taking money from our 401k and all of that. We have to understand that. I'll just bring it down to the lowest tax return, like IRAs. IRAs are cool. I mean, you can get to IRA and at the same time, it becomes deduction for you if you do it before April 15th. For 2023, you can take up to $7,000, $6,500, and if you are over 50 years, there's something we call a catch-up contribution, which is $1,000. So if you are 50 years, you can do up to $7,500 and make it a deduction as an adjustment to your tax return without taxes paid. Then for 2024, this year, it is $7,000 if you are below 50, and it's $8,000 if you are above 50. Again, these are IRAs, individual retirement account. As compared to 401k plan, 403b, 457b, these are all pension tax code under the tax code. For 2024, you can put aside up to 23,000, and then if you are 50 years, you can also do the catch-up contribution. Now, IRAs, if you do the traditional IRA, which is the pre-tax deduction, you cannot make contribution when you are 73 years. Why? Because IRA doesn't want you to transfer your asset to a younger generation. So when you get to 73 years, you can no longer contribute into traditional IRA. But for Roth IRA, it doesn't matter. Whether you are 100 years, you can still contribute, but not traditional IRA. Because traditional IRA is tax deferred. And the service doesn't want you to transfer your asset to your grandson and your grandchildren tax-free. So they say, no, you can't do that. When you're 73, stop right there. You can change to Roth IRA, that's your problem, but you cannot contribute at the age of 73. So if you over-contribute, you pay taxes of 6%. Instead of contributing $7,000 or $8,000 for this 2024, if you do $9,000, you have over-contributed, and so you pay 6% of the amount, that excess contribution. But unless you withdraw that amount with all the interest before April 15th. So knowing traditional IRA and Roth IRA is another area that you want to discuss with your accountant, because you want to find out what will your tax bracket be when you retire. That will influence you to decide whether or not you should have a traditional IRA or Roth IRA. And guess what? When you have a portfolio for your retirement, there's another requirement called a required minimum distribution. What it means is that at some age, IRS will tell you, listen to me, you are 73 years, so you need to start taking your money out from your pension plan. We don't want you to pass that money to your beneficiary or to your young generation. So there's a minimum amount you should take out. It's called required minimum distribution. So let's say that Amanda is, you are 73 years, you have $100,000 in your IRA or your pension plan. You got to take $3,000 a year. If you don't take it, they will tax you 50% of the amount that you did not take. All right? If you didn't take it, 50% that you did not take. It's called excise tax. So, and it's requirement. If you don't take it, they will tax you. So if you don't take the amount this year, $1,000, they will take $500 as tax. So they require you to take that. Is called the required, and the word there is a very important word, required minimum distribution. You can take 5,000, but the minimum you should take is 3,000. If you don't take it, we get a tax to 50%. Again, you want to also talk to your accountant to see how you should address this. Can you take the money from your actual pension plan and put it into a Roth IRA if you don't need it? Can you put it somewhere else that will benefit you? All will depend on having a clear discussion with your accountant who will know better and who will know your structure, who will know your history and tell you exactly how you should go. So when it comes to Roth IRA, there is no required minimum distribution. There's no restriction when it comes to it because it is already a post-tax contribution. What you have tax that? And then you better home feel how someone. You don't care. The one that you haven't paid taxes on, they won't let you keep it forever. You got to take it. Otherwise, you pass it on to your grandsons who are only 6 years. They also keep it for another 73 years and pass it on. So this you will not be paying tax on the money for hundreds of years. So the Roth IRAs are very convenient, no hassle. But again, talk to your accountant, find out the best retirement plan for you. And then you can start it small. Don't wait. Now that you can work, now that you can have the energy to work, do it now. Because Social Security might not be enough for you. You need this retirement plan, a little bit that you can get from here to support you, right? Because it's so important. And again, here the system is that, and this is what I've seen myself, and I've told my students all the time. If you cheat the system from one end, you're going to meet it somewhere else. Okay? You can go ahead and cheat the system. I made $80,000 this year. I'm going to pay taxes on only $3,000 because I don't want to pay taxes on it. That's okay. But then when you retire, your Social Security benefit will be based on $3,000 a year. Okay? So it's always good to look at, as a dream kind, we should be 30 years ahead from where we are today. Because I just said, yeah, Brian Timin, sorry, you will live in poverty because we cheated the system from day one. We thought it was okay because we could, let's cheat it. But then when you grow older, that's when the system catches you. I think we'll end here for questions, and either myself or Mr. Minta will, the ones we can't answer, we'll write it down, we'll get you later on, but the ones we can, hopefully we can get answers for you. Doris, I think I'm done for now.
Thank you so much, Mr. Finance Director, Dr. Frederick Ansel. And Mr. Minta, thank you for your services that you provided. Thank you. I will, if my director of DSS will give me the permission, I would have said that for the supplementary pensions and the private pension planning, it would be great if we had a full session on that one alone to teach us, some of us that are so young and working, to know that Social Security is not the pension we need to wait for, because we're going to be homeless if you rely on Social Security. Thank you. I have two questions in the chat room. The first question that I see in the chat room says that the Congress is still debating on the child tax credit. Is it wise or is it good enough to file the taxes after that decision is made, or is it okay to file it before the decision is made? That is the first question that I have, and I think that's for Mr. Minta. And the second question that I see also on the chat room says that if you are married, filing separately, is it none of you, all of you guys are itemizing? Is it okay? Is it good to file separately, or you have to file jointly? That is one thing that I see. So there are two questions in the chat room. If you have any questions in the point the area that says reaction, you can show your hand up so we can call you to answer. So, Mr. Minta, if you be kind, somebody's asking whether to wait for the child tax credit or to file before the tax credit decision is made.
All right, thank you. For the first question, I would say don't wait for the Congress to pass any law yet. Okay, go ahead. If you have all your tax documents, go ahead and file it. If there is anything that after the law is being passed, you can always go back, amend it, or they'll make replication for whoever is affected by it. They will do something for you to claim your additional refund if there is any. So do not wait for it, because these things could go on and you'll be waiting. I wouldn't bet on it anytime soon. If anything, even if they pass it, it might not be in effect until next tax season or something like that. So don't wait on it. If you're ready, go for it. Whatever it is, you can always get it back. All right, that's the answer to that question. Fred, do you think otherwise? What would you say to that question?
Which was the other one?
No, I'm saying the first one. I could answer the second one as well. But the first one was, they said they are waiting. Should they wait for Congress to pass the new tax bill?
It's a debate that's going on in Congress, and it's actually from the Committee for Taxation, and there's no retroactive.
Right.
Well, even if it's passed, you can't go back and do that. It's forward. So we can go ahead and file our taxes. If for any reason the voters should put retroactive, they will tell about. For now, they are fighting for a future what do you call it? Amendment. Yeah.
So the second question regards to married filing separately, if both are itemizing and things like that. From what I understand, right? So the tax code does not support married filing separately. In most cases, if you can, avoid married filing separately at all times. There's certain situations may be beneficial for you to do married filing separately, but if you can, because we always do the comparison. Like I have clients that I will split it up, and you see that at the end, the take-home pay, if you are doing married jointly, is more than doing the separate. The married filing separate is the worst status you can. There's even certain things that you can't, certain credits you cannot get if you're doing married filing separately. So you don't want to do that if you can avoid it. Again, it's a numbers game. So based on your income, we could look at it in both ways and see which way it's been. I'm always running that kind of things for my clients to let them know, because when I say they don't believe it, but there's numbers, there are situations that if there's highly income and different things, then you want to do it. But always stay away from married filing separately if you can.
Thank you so very much. I have another question in the chat room that says, can you use your traditional 401k towards your first home down payment without paying the penalty? I think that's
take that?
I didn't hear Derek, are you talking?
So, yes, it says that can you use your 401k towards your first purchase of home? Is that an advisable thing?
Yes, personally, whether it's advisable is a different story, but I've done that before. Instead of me to go for a loan from a bank, you see what happens is that when you take a loan from your 401k, the interest you pay goes back to you, as compared to it's one of the things that I propose, that it's one of the tax planning. So they cut credit cards, be 20,000. Now we treat interest of 29.9%. Now so a pension plan I wouldn't call retirement. Now we treat interest, Why don't you take the loan from your pension plan, pay, if you can discipline yourself though, pay off the credit card and then pay the loan to your own pension plan with the interest. So it's a tax planning aspect that we overlook, but it can be very substantial. And I've done that. I took a loan for my pension plan. All the interest went back to my portfolio, as we go to the bank or to a third party. So the answer is yes.
Okay, so the person was asking if are you going to pay a penalty? If you just like, is it going to be like a distribution, or it's just going to be?
No. The penalty doesn't. The penalty doesn't cover that. What happened? The penalty, they give you, if you are buying a new home, they give you a chance to take more money, like 50K, I believe, as of last year. And without most cases, you can't take half of what you have in the portfolio if it's a defined contribution plan. But then if you are buying your first home, they give you the allowance to take more money from it. But that is not one of the exceptions to avoid 10%. No.
Thank you, sir. So there's another question from Teresa Boateng. It says, if you did not file your taxes in 2022, is it okay to file it in 2023? To file both 2022 and 2023 in 2023?
Answer is yes. Okay. The sooner you realize that you haven't filed your taxes, the sooner you file it, it's better. There's always going to be a late filing penalty for the ones that you're late on, so the sooner you do it, the better. Yes, you can. The answer to your question is yes, you can file both in 2023, but it has to be separate returns. You're not going to add it. They're not going to add it. So they're going to do your 2022 return and they're going to do your 2023 returns.
Thank you. The next question says, good evening. Please, what if you are employed, but also have a sole proprietorship? Does the self-employee tax come into play? Thank you.
Yes.
Go ahead.
Yes, the self-employee tax is going to be applied to your net profit from your self-employment job. Okay, that's always going to be there, and your sole proprietor, your W-2 income is going to be at the end. Your total taxes, they're all going to combine it total, but you're still going to have a self-employment tax for your sole proprietor if you make profit from that sole proprietorship. Fred, go ahead and add anything you can to that.
Yes, I think that you said it all. You are looking at it from both ends. If you're an employee, you file W-2. If you are self-employed, you file Schedule C, right? So if you're a Schedule C filer, which is a self-employed, which is a P&L of your trade or business, then your net income is transferred to your 1040. So what it means is that the same way, whether you are a partner in a partnership, whether you are a sole proprietorship, or whether you are an LLC as a disregarded entity, all your income will flow to the 1040. That is only for the side where the 1040 collects all income. So whether you have W-2 or you have 1099 non-employee NEC, non-employee compensation, or whatever form it may be, it's done separately. By the end of the day, the two will have to meet somewhere, and that's the 1040.
All right, Doctor, thank you so much. There is one about the minister. What do the ministers that the locals are not giving them a 1099? If the local is not giving them a 1099 or W-2, how do they file their taxes?
Yeah. I don't know if the local is not giving a minister W-2 or 1099, then we are in trouble. Okay, because I guess we've done a lot of training on this. 1099, because the law is saying that anyone who receives a net income of earnings of $400 or more a year must receive 1099 non-employee contribution, must file taxes. So the law is the law. And if it's not happening that way, we need to fix it and do that going forward.
So let me add to that. Even if they're not giving you something and you make it, as a law-abiding citizen, you could come out with hopefully you're tracking your compensation somehow and somewhere, and you do your side, your part, right? You as the taxpayer, you do your part to come up with your estimated whatever income you think you may have to cover your part, and not necessarily, because sometimes if they didn't give you, that's something that the law would deal with the ministry itself if it hasn't distributed 10 in that. But you, the taxpayer, also have to make sure that you're doing your due diligence by filing your taxes and coming out the best estimated what you think you made along with your expenses to file your taxes.
Thank you. So the next question is, I think it's for Dr. Anso. Dr. Jobina, can you transfer your 401k directly into your IRA account?
Yes, what happens is if there are two components when it comes to pension plan, whether it's a qualified plan or non-qualified plan. You cannot transfer from a qualified plan to a non-qualified plan or otherwise. So if the two plans are qualified, means they are tax favored, then you can do that. But the point is that why would you transfer from 401k to your IRA? It means that whether you are leaving your job or you left your job and you want to put money aside somewhere else, you can do so. But remember that there's a threshold for what IRA. IRA has its own threshold, whereas 401k is 23,000 a year limit. IRA is only 8,000. That's if you're 50 years plus. So if you are going to move money from your 401k to your IRA, you need to assess and see, why am I doing that? Is it because I'm not doing well in this portfolio and can I do something better? Again, if the two are qualified plans, you want to look at it and do so. But if that's not the reason, then I wonder why somebody want to do that. Unless you really believe that the amount you have in there is not a huge amount, which is not above the 8,000 threshold that you're supposed to be transferring.
All right, Doc. That's why I said we need a new class on this supplementary pension plan, and the whole class that will just pay attention to this. There's a question about the child tax credit. Somebody wanted to know what exactly they are debating, and do you have any idea what numbers are they likely to bring out this year?
Right, you want to take that?
Yeah. What happened is that before the Secure Act law was passed in 2020 by Biden, there was a room. They left a room for any amendment to be made for all the Secure Act items, which were part of the Tax Cut and Job Act by Trump. So when Biden came, he selected some of that's why some of us received some checks. Remember once Biden came, you got $250, some got $1,005. It was just advanced tax credit. Now, when you file your 1040, you got to pay it back. It was used to offset your tax credit, and if you don't claim that child that year, you got to pay the money back. So that law has been there. So what Congress is doing is that should they extend it, or should they completely, terminate that particular law and take it out of the Secure Act, because it doesn't seem like it was any help to the taxpayer. And if they are going to leave it there, then of course, Committee for Taxation is saying that then we need to reassess it and then extend that instead of paying 3,000, I think it's 3,000 and 3,006 for 3,000, right?
3,000, 3,006.
Yeah, we should rather make it bigger, because parents who did not use those kids at the time had to pay the money back. It's a debate going on, and unless they finish for us to see the blueprint, but it's been going on before December, and they're still debating. So we'll see.
Okay, so it's a wait and see game till they bring out the numbers. And the next question said, is it possible for you to let the Social Security pay your Social Security pension or the money to the IRA?
The answer is no. Let me. Social Security is a different body, and what they do that. So those of you, like another time, we'll find time to look at how it's computed. Very interesting computation of how you get your Social Security. You can do that, but then of course, when you take your money from your bank and you are below 73 years, you can put your money into an IRA, which is traditional. If you are above 73 years as of this year, they can put into a Roth IRA. Yes, but you cannot have Social Security pay the money straight into that. What happens is that when people, if you were a beneficiary of a deceased, so for example, if two people are married and the husband is making $1,000 and the wife is making $400, when the husband dies, the wife now decides it will now be required to take the husband's $1,000, the $400 is gone. So by the time, if the husband was having any excess income for any reason, what the law was, when Roth IRA was passed, they were going to allow people to do so because the wife doesn't need $6,000, he only needs $600. So why don't I put the remaining $400 into an investment vehicle, which is an IRA? And they said, no, it's not a government business to invest for a taxpayer. Let a taxpayer decide on their own and have the obligation to move that money from their own account into any form of retirement, including an IRA or simple IRA or SEP IRA or the families of IRAs. So you can do so, but you can do so on your own. But Social Security cannot put that money into it for you. It's as if they wouldn't do that.
Thank you, sir. There's a definite no. So the next question says, if you are receiving Social Security and also working, and they actually deducting taxes from your income whilst you are over 70 years, do you have to file taxes?
Yes. Social Security, whether or not your Social Security income is taxable, is seen differently from your W-2 because you are working. But whether or not it's taxable would depend on 1/2 of your Social Security benefit received plus all other income. Okay? So let's assume that you receive 10,000 from Social Security. It's 5,000 plus all other income, including tax-exempt income. And then when you get that amount, it's called provisional income. You compare that amount to a table by IRS and say, okay, if I'm single, I have this amount, where do I fall? And say, well, 50% of that amount of your excess benefit should be taxable. So you have to determine that first. So if you are working and you are receiving Social Security, and whether you'll be taxed would depend on your provisional income and the table that goes with it, and said that you made this amount 10,000 from Social Security, it's 1/2 of it plus all other income, including tax-exempt income, and then you made, let's say, $12,000, and you go to the table and say, well, if you are $12,000, then you don't pay any amount on Social Security. That means that your excess amount is tax-free. But if it tells you that it's 50%, so you can actually pay up to 80% of Social Security in taxes, depending on your all other income or your provisional income. So there's a computation that goes with it. But the bottom line is that it is your Social Security benefit received plus all other income. It's 1/2 of the amount received plus all other income, including tax-exempt income. When you have some amount to be paid, we can compare that to your table. I'm fairly single, I'm married jointly, or whatever it may be, and see whether the amount you have, the provisional income, falls within any of the bracket, 0%, 50%, or 80%. And that is when your excess amount will be taxable or not. It will be determined by your provisional income, including all other income.
Thank you, sir. Somebody's asking a question. He receives stipends from his job. Is that also taxable?
I'm sorry, I didn't hear that.
He gets stipends from his job. When you get a stipend, are they also taxable?
Well, the tax code section 61 is all income, irrespective of where they are derived from. So even if you get money on the floor, it's supposed to be taxable. Unless there's a tax code that says that stipends are not, then it will be exempt. Other than that, it's taxable.
Oh. Every donation, everything is taxable, right? Oh, wow. So somebody's asking a question here. The different categories of tax selection, such as filing single, married filing separately, married filing jointly, are they only for tax purposes? or is supposed to align with your true status?
Is that
That
there?
I'm just
Yeah, yeah. It's mainly for your filing purposes. Okay, and you know it kind of have to align with your day-to-day status. You cannot say you're married filing jointly if you are not married, right? For instance, right? And you cannot go and say by the tax code you are single when you are married, right? Like I remember some point where Dr. Anderson was giving the thing. He says you could cheat the system today, okay, but down the road it could come back and bite you, okay, because all these things is is prepared, is designed. It's a system that is designed. If they don't get you here, they're gonna get you there. So it's better to align with what your status are and file with it, and that's how your conditions are. So and like I sit here and I do taxes, I see people go around it. A colleague once described this tax code as the highway, right? It's like the speed limit. It's posted out there. It says 65 miles per hour, right? People go 70. Some people go out and never get a ticket. They go. Some people go under, and sometimes they get a ticket. A new driver might go right from the motor vehicle and they get a ticket. And somebody be driving over 65 for years and never got a ticket. The same thing with the tax code. So you could play with it, but the day that it'll come back and bite you will be thing. But it's a system. So if you leave by the system, the law abide for says this, and then you want to align your code with your status. That is in the short.
Okay, thank you. So that if I'm married, I can file single. It's gonna come back to bite me.
Yeah, at some point. Yep, because you're gonna fill some documents, and it's gonna it's gonna bite you. It's gonna bite you here or there.
Okay, thank you. I think back to you, Mr. Minta. I'm coming back to you now. So I have a W-2 from my church. My church gives me. I'm a minister. My church gives me a W-2, but my district also gives me allowances. How does it affect my tax filing?
Like Fred said, the ministry things that there some allowances. I think, correct me if I'm wrong here, Fred. With the allowances for the ministries, those are they get free allowances. Isn't that considered something else? I forget what it described as the allowances.
Yeah. What happened is that ministers receive housing allowance.
Right.
The
Exactly.
housing allowance are tax-free for federal tax purposes only, not for Social Security or Medicare taxes, right? So when you actually file your taxes, let's say a minister makes $50,000, $100,000. They will say, you know what, predetermined. The minister is going to pay $40,000 for his house allowance, his rent, his light bill, his all of that. Now, for federal tax purposes, he will be taxed with only 60,000 will be taxed. But for self-employment taxes, the entire 100,000 will be taxed for both Medicare taxes and Social Security. So when you're a minister, you receive W-2 and you receive an allowance. If the district doesn't give you 1099, there's a line called other income on 1040. Just like Minta said, you need to compute that and put that amount on your other income on your 1040. If you get 1099, that is fine. If you don't get it, so that you can be off the hook in case there's any audit. Because they can be industrial audit. They can take churches within the District of New York and audit all of them. So you have to put that on your, but the best practice is for the district. If it's more than $400, probably report it or something like that. But if you don't get that, it's okay. You can put it under other income and report that. Yes.
Thank you, Papa. I think somebody is asking an investment advice. I don't know if it will be bold enough to come out. It says, is there a private annuity that you can roll over your 401k into that will give you a better interest rate? and protect your investments even when the stock market is doing bad? That's a question. That's an investment advice.
Okay. What happened is that annuity is a contract, right? It's a contract between you, the taxpayer, and a bank or financial institution, and say, you know what, I'm going to put down $15,000 for 10 years. I'm not going to take a dime out for that period. But then after 15 years, pay me $400 a month until I die. The contract. So if you break the contract, then whatever terms you have with the bank will apply. But then, of course, if you take your $400 annuity and you want to reinvest it somewhere else, nobody prevents you for doing that. But if you want to take the entire annuity package portfolio and invest it somewhere, it means before the 15-year term or 10 years term, it depends on how many years you actually did a contract. Then obviously you are breaking the contract, and every amount you have accrued, there may be a penalty for breaking it, like a CD. If the CD is not matured yet for 2 years and you break it, the penalty. The same way. Yes, maybe you can. You can easily revoke. It's called revoke. You can revoke the contract, but it comes with a penalty. You can take the money from the annuity and put it somewhere else. But then if it's an annuity that you have, then obviously there's a contract that says that you make this amount after your 10th year. And they will pay you that, whether the market is good or bad, they'll keep on paying you for that. Or you can lock it into an annuity and say, we guarantee you 10% for 10 years. If the market is bad, market is 2% or what is it, we'll give you 10%. If the market is 15%, we'll still give you 10%. Your 10% is guaranteed. The contract specifies it. But if you break that contract, it comes with the penalty. The penalty depends on what kind of contract you have with them. So you can definitely take that money into your 401k. But remember that 401k is an elective portion of it, where you elect and tell the employer, I want 5% of my income to go to 401k. The employer will match it or otherwise. All right. If you want to put it into Roth 401k, that's a different story. But if you want a traditional portion, it's a pre-tax contribution. So the annuity contract will tell you. That's why it's always important for us to have accountants look into it, the contract, and said, you can do this. If you do this, all the money you have accrued for all these years will be gone. So wait to probably end of the contract, or take the whatever amount is due you after a 10th year and reinvest it somewhere else. So it all depends on what is stated in the contract. And then with that, I'm sure I think you should look at it from accountant's point of view. Let the accountant look at it, and then they will advise you on that.
Doctor, it was the other way around. The person has a 401k and wants to roll it into an annuity. Wanted to know whether it states you can advise the person on a good one to roll it into.
Another one, if you want to put a 401k into annuity, it means that you are going to have a distribution from your 401k. If you are not 59 and a half years, it means that if you have a 401k, if it's a traditional 401k, you are prepared to pay the penalty, take the money from the 401k and put in an annuity. Annuity is a contract. Tell them, hey, I'm getting 8%, 2% from the market. I don't like it. I want to lock it for 10 years, 10% of interest for the next 10 years. In that sense, on the 401k side, it's a distribution. Okay? It's a premature distribution. You pay the required taxes. So you have to look at the quantum of how much you are taking and the taxes that you pay, and see if you can make that taxes out with the 10% that you are paying on your under the annuity contract. It's a comparison that you have to make. Otherwise, you go and pay, you will pay like a huge amount of, let's say you pay like 5,000 penalty from the 401k in taxes, but then it will take you like 3 years or 4 years to get 5,000 from the annuity side. There was the point, right? So all would depend on your tax planning and how you actually have to lay out all the records on table and do a better analysis and say, hey, 401k, I'm not making anything. But 401k nowadays, the market is good. If it's aggressive or mutual funds, maybe you do better than, and it's a flexibility. You can take the money anytime you want it. But the annuity is locked for a number of years. Yes, you can, but you have to go for distribution first, and then you put it into an annuity contract. Yes.
Mr. Cabral Blay, I've been here just posted that the House just passed the child tax credit an hour ago, are waiting to go to the Senate, increasing child credit to 2,900 this year. So that's an information that he wants to pass by. I know it's going to be a public information in 2 minutes. The next question says, annuity a good retirement portfolio to supplement Social Security income?
Yeah. So if your Social Security and one like I said, annuity is a fixed rate. All right. So if you don't have the heart, if you are very conservative, all right, and you don't have the heart for the market, where it will go down, so you have 10,000, it will go all the way to 2,000, and then you need, you'll be panicking and having stress. Then put it in the annuity and say, lock the money here for me for 10 years, 10% interest rate. Then you know that you get a certain amount from annuity, which is $500 plus certain amount from Social Security. And that one, you are sure of getting that from there. But from the market, it's on the market. So it can go up, it can go down, it may vanish, it can do anything. You're on the market. So annuity, if you are like me, I don't have the tolerance for investment, I'll go to annuity and say, take my $50,000, give me $800 a month at my 60th birthday, and I can see that I'll get $600, $800 from annuity, and I'll get my Social Security. I can live within the two. Because I can become a king there. I'll live with the two, and I'll do better there. So it all depends on how you plan to live. And again, we need to whilst we're doing that, you have to understand what you want. Do you want financial freedom or you want financial independence? All depends. This is what actually will make you, it will influence your investment attitude. Do I want financial freedom or I want financial independence? You have to understand the two before you move on with any investment that you go in. If it's all about freedom and it's all about independence, well, the two are not the same. So choose what you want, and based on that, it will influence you the kind of if you do annuity, and like we said, the question you just asked, I want my freedom. I don't want to worry about anything. Give me 2,000 from Social Security, give me 800 from annuity, I'm good with it. But I want my independence. I want to live above what I can imagine. Nothing should restrict me. Then I'll put the money on the market. If the market goes up, I get more money. Or I put the money into a place where I can get more money. So again, when it comes to retirement, when it comes to decisions to be made, your accountants are the best people who can advise you because they have your history records. They can tell you that based on these records, this will be your tax bracket in the next years to come, couple of years to come when you retire. So if you want financial freedom, do this. If you want financial independence, do that.
Okay, Dr. Onyamishra. So Nana Kwame Boateng will be so pleased to hear from you. Proclaiming Abini. It says that if you are married by filing separate and you have mortgage interest to apply, can each use half of the mortgage interest, or only one person can apply? Can you use it?
Derek.
Yeah, you can use half. You could split it. You could split it half and half to use it. Just make sure you have the proper documentation to back it up, okay, when it comes to it. But you could definitely use it in splitting. I've seen it, especially if both of your names are on the mortgages and things like that.
Okay, so my last question in this chat is that who is to pay the 7.2% of the employer or of the minister if the employer fails to do so in previous years? Can he pay arrears? I'm not sure exactly. Dr. Also probably understands it better.
Okay, who is to pay the, okay, there's it's 7.65%.
Okay.
Okay. Yeah. So if who pays that if the employer of the minister, if the employer fails to do so? Well, if if a minister is in a congregation or a minister is an employee congregation, then obviously the minister will pay her portion of 7.65%, and then the congregation, which is the employer, whoever the employer is, will also pay the, like I rightly said, the 7.65%. So I'm not sure how to address the previous years, because if it's not that, because you can't go back and do amendments, then you have to go back. Then of course there's a set of limitation as to how many years, how far back you can go, right? If you want to go back and do W2Cs or amend your W2 and say, hey, employer, you didn't pay me this, so pay me that. That's a different story I can look into. But again, the employee pays the portion, the employer pays the other half. Between the two, employee and employer, is 15.3%.
Dr. Onyamishra, Adumyaf says they have a follow-up to the different statuses that we have. Adumyaf, are you still on? You can come in.
Yes, please. Thank you. Thank you for the education. So yeah, the follow-up question on that was, let's say I'm filling the W-2 at my workplace, right? Like you said, they determining the effective and the marginal, whatever. And then at my workplace, I decide to go for single but filing separately. But in actual fact, I'm married.
Yeah.
What does that mean?
Okay. Yes, Adam. What happened is that if you are married, you are in a lower. If you make $1,000 and you are married, you are into a lower tax bracket. If you are single, you're in a higher tax bracket. So if you say the worst case scenario, I said where I'm married, but for tax purposes, I want to be taxed as if I'm single, so that I can pay higher tax bracket. I can pay 24% or 37%. But when I file my 1040, I will file as married. So in this scenario, we come back to the same marginal and effective. You are having a higher marginal tax bracket. You are in a higher tax bracket. When you file your taxes and you declare that you are married with the same income, you go into, let's say, more likely with other deductions and credit, you're probably in the lower tax bracket. So you can. That's why IRS form has that. Married by filing single. I'm married, but for tax purposes, I want to be taxed as if I'm single. So don't, because if you make $1,000 and you say you are married, the system is looking at as if two people are going to chop your $1,000, so they will tax you less. But you say, no, my wife also works somewhere else, so I'm married, but tax me as if it's only the income is for me alone. And then, of course, the bracket goes up, right? So all things being equal, if you are married but fast single, you are into a higher tax bracket because the income will be attributed to you alone and not the two of you. If it's the two of you, then it's spreads. If you look at the table that Mr. Minta gave us, it spreads as married, you are paying less income, you are paying, your marginal rate is lower because it's as if two people are earning $1,000 as against one person earning $1,000. The tax bracket is different. Right? So that is why most people will say, you know what, I'm married, but you know what, tax me as if I'm single. But then when I go to my 1040, I got to say I'm married. So I'll have more taxes coming out from my marginal. It's more likely that, so to be on the safer side, people do that all the time. And I see that happen a million times.
And then
and to add that, it just people do that because it helps. In other words, it helps. At the end, you come out on top if you go that route.
Got it. Thank you. Yeah, thank you for that clarity. The second question has to do with withdrawing from the 401k. I know you were given the scenario of paying your credit card debt if the interest is 29% or whatever. But are you able to reconcile that with once you withdraw it, the lost opportunities, you are like the foregone interest or gains that you get in the market for withdrawing it?
Yep, good point. You see, the point is that's what I say it requires analysis. Well, like last year, the market grew by 10.1%. the year before that. So 3 years average, the market has grown like 9.7 because of COVID-19, it went to 9.7%. Okay, so if you take $40,000 and say, you know what? Remember that when you take the loan from your 401k, you don't take it interest free. You are also being taxed an interest, even though it's lower. You be taxed an interest like 5%, 4%, depends on the market, or depends on federal rate. So if the market grows by 9%, and you are also paying 5% of the same money that you took, when a net of 4%, compare that to 29.9%. Okay, it's the worst case scenario because, and like I said, it's tax planning. Why would I want to pay 29.9%? But like I also said that unless you can discipline yourself, if you're going to use a credit card and they use it again, then what is the point? All right, you want to know what? I want to pay off my credit card bills, pay it off with my 401k, and pay the loan back to my portfolio. What it means is that you need to discipline yourself and get away with the credit cards. But if the next morning you're going to use it again, then don't bother, because then you are worse off. But again, the interest rate is 5%. The market grows 9%. You are only in a hole for 4%. Compare that to 29% that you are paying on a credit card. I mean, if it's 5,000 or 6,000, don't worry about it. But if you go like 40,000, well, I pay like almost $300 a month on interest rate, when that money can be paid into your pension plan by taking your own 401k to pay off the debt and then destroy the credit card and pay it back. You know how much you save?
Excellent. Thank you, sir.
So, hi, Doc. Thank you, Doc. Our last question for this class is already 9:56. It's please, if you want to take money from your 401k, say 40,000, how much taxes do you have to pay for both federal and state?
Well, Mr. can come in, but if when it comes to federal, there's if you are below 59.5, you need to pay 20%, 10% requirement for taking a loan from your 401k. If it's a loan, again, let me make it clear. If it's a loan, it's a loan. There's no penalty for loans. It's a distribution. If you're distributing, taking it without paying it back, then you are required to pay the 10% for taxes withheld and a penalty of 10% because you are below 59.5. If you're over 59.5, you only pay 10%. When you file your taxes and you are supposed to get it back, you get it back. It depends on other factors. But again, distributions are different from loans. Loans are supposed to be repaid. So there's no penalty for, unless you default the loan, then it becomes distribution, which is when the penalty kicks in.
Thank you so very much, Mr. Mintai and Dr. Jabana, for your time and your expertise on these topics that you have shared with us. We know that when we call on you again, you will not hesitate, but you'll come and be nice and wonderful to us like you've been. This time, I will also say thank you. And I have a special sister. Sister Delis also is on the line to give us a vote of thanks.
Thank you so much. Thank you very much for this opportunity. I am so grateful to be doing this. May the peace of the Lord be with you all. And on behalf of the Presbytery DSS Committee, I would like to first give thanks to God for allowing us to be alive and well today. Secondly, we would like to thank the chairperson of the North America Australia Presbytery in the person of Reverend Papa J.J. Kumidiodu, and also the Presbytery clerk, Reverend Dr. Euku Jampo, and also to all the ministers and catechees who made it possible to be here today. We would also like to especially thank our esteemed speakers, Mr. Derek Minta and also Dr. Frederick Dramana, for availing themselves and educating us on such an important